Hello, everybody. My name is True Demon, and I'm the Devil's Stockbroker, and I'm back. It's nice to see everybody. I want to start this video off by apologizing for a very lengthy absence. I uh, I left the channel with my previous video on December 30th, I believe it was. I've already explained to everybody that's already in Hell's Trading Floor what's happened, but to catch everybody else up who's been concerned about why I've been away from Twitter and YouTube and so on and so forth, I at first took a vacation, but starting with the new year, I have, for those of you who don't know, I work a day job, and some changes have occurred with my work situation that's forced me to pay a little bit more of my attention and focus and effort to that. So, unfortunately, that created some interference with what I'm doing here on YouTube and in Hell's Trading Floor. But I just wanted to let everybody know who has shown concern about my absence. I know that I kind of left things off on a bit of a somber note because of my own personal frustrations with people on social media being rather rude about me and other members of the financial YouTubers groups. And I just want to let everybody know that I'm fine. I'm doing okay, and nothing bad is happening with me and my work. I'm just extremely busy, and that's really all that's going on. I don't want to go into really any more detail than that, but the long and short of it is that I'm okay, and nothing is really happening other than just I've been super busy at work. But that is going to change very shortly, I hope. So I should be able to enter in a more regular upload schedule and focus on bringing content to the channel and calling out new plays to everybody very shortly. In the long run, this will be better for me because it's a good thing that's happening at my work, but you guys don't need to hear all the details. The most important thing that I'm sure that you guys are all wondering is what is going on with the stock market. And of course, I wouldn't be doing my job if I didn't give you guys some of my thoughts and insights into what is currently going on with the stock market overall. So there's going to be a more in-depth video into this, and I'm going to cover some more tickers later on in a future video when I have time to go ahead and sit down and do a proper recording of everything. But I have been taking note and paying attention to what's going on in the market. Okay, so I'm going to give you guys my quick blow by blow thoughts of what's currently going on. First thing that you'll probably notice is this giant megaphone pattern, which has been drawn out in the stock market for several months. At this point, it's the most obvious megaphone pattern, and if you haven't seen it yet, then you've been living under a rock because literally everybody's talking about it. So, what is this currently telling everybody? Generally speaking, these megaphone patterns are continuation patterns. In this case, it's very bearish because it's in this overall downslope, right? So everything is moving down. And that's the general trend of our bear market. Now, what's happened significantly is that for the first time, we've had a series of closes outside of this megaphone, and it would generally point to there being some kind of a breakout. This is the first breakout that we've had of this megaphone pattern, and I can guarantee just about everybody is looking at this and saying this is a signal that the bear market is over, and this is going to be a big uh, catalyst for traders to push money into the market. This is a recovery signal that a lot of people look to. However, the problem is that there are several signals that this is a false break. And the reason why is because this is a almost identical setup to what occurred in 2008. So I want you to count very carefully, pay attention to the first top that we had, followed by number 2, number 3, number 4, and 5. And then this would be the 6th test of this megaphone. So this right here is the chart on the S&P for 2007 through 2008. This is the famous great financial crisis that occurred back in the late 2000s that was brought about by a massive housing crisis due to overleveraged financial assets that were poorly understood and caused a extreme amount of chaos and panic on Wall Street in late 2008. Specifically, this occurred in from the summer to the fall of 2008, ending in this really spectacular financial crash that saw the market giving up more than 40% of its value in just a few months. So why is this current crisis that we're going through very similar to this one that happened in the past? For one, there is a direct comparison in the housing market in that the 2008 crash followed a massive housing bubble that was triggered rather by a massive overabundance of homes and mortgage availability and poor lending standards that caused banks to be able to and incentivize banks to give out mortgages to people who should not have qualified. Since that time, lending standards have improved. However, it was those devices which were extremely over-leveraged and poorly understood that led to a massive wave of defaults because people who did not qualify to pay for their homes ended up defaulting on their mortgages, causing a massive wave of defaults that then caused those assets in the market that were based on the sale of those homes and mortgages to go worthless. You can think of them as a derivatives device, which is similar but not the same as options. It's quite complicated, but the long and short of it is that this massive wave of defaults caused this. Now, at the time, just before that collapse had occurred, the stock market had gone through more than a 25% decline before it had finally looked as though it was getting ready to make a turnaround. And at that time, this megaphone pattern was starting to show signs of breaking out. It was a very early bear market at that time and resulted in generally everybody starting to get a little bit more hopeful that things were going to turn around. However, after another month of a big downturn and then a final attempt to recover, the market plunged on the word that the housing market had collapsed, and this resulted in a wave of losses and bankruptcies in the financial sector, the biggest ones being Bear Stearns and Lehman Brothers banks. Now, the difference between now and then is that if you look at this chart, notice that 23% down from its peak in the market is where it was right as it was starting to make a recovery and then one big spectacular waterfall style crash. If you go from peak to trough, this market took more than 500 days to reach its bottom from its peak, and it lost more than 55% of equity value in the S&P 500. So hang on to these two numbers, 23% and 55 or 57%. So this is the lowest low in our market from its most recent peak, which was a loss of approximately 27%. And we have since had a big leg that challenged that megaphone top. However, every single time that we have had a big push for the top of this megaphone, we have had a very spectacular rejection, and it caused the market to plummet. And that is what I'm predicting is going to occur again very soon. My reasons for believing that the market is going to reject here is because we have had several closes in the past that were above both of these 200 period moving averages, but we saw quick rejections after challenging this ceiling. The ceiling that we're currently at is still below the strongest level of resistance. And if we reject here at $400 on this SPY, then I anticipate that the market will, in spectacular fashion, reject once again. There's several other catalysts that people have to pay attention to and be aware of, that most of this surge, most of this recovery that everybody is calling for is based on speculation that another Fed pivot is coming, which is something that everybody has been hopeful for in the financial sector, but is completely disconnected from the reality of the problem, which is inflation is still out of control, and while it may be falling, is still too high to be sustainable. And if it remains this high, then it can still become entrenched. And I feel that this is strongly dependent upon the housing sector, which is now at the top of its channel on the XLRE index. The XLRE index is a ETF which tracks Commercial and residential real estate REIT funds. These real estate investment trusts, or REITs, are investment vehicles and companies which specifically target the real estate sector for mainly commercial and some residential. This fund has been doing extraordinarily poorly since we have hit the peak in the market. And every time that we have touched the top of this channel, it's gone back down very, very quickly. So this is the thing to watch for in the coming months, because right now we are coming out of a seasonal slow period in the real estate market. And then starting in February, homes come out onto the market. And something that very few people are paying attention to and tying together with the stock market is that there are a massive number of homes that have been pushed out onto the market by institutional investors that bought up massive amounts of homes on credit that they couldn't afford because they were speculating that the value of the homes would go up due to the euphoria from the housing bubble that we just experienced. All those institutional investors, which include names such as BlackRock, Blackstone, Vanguard, Wells Fargo. This article by ProPublica, When Private Equity Becomes Your Landlord, details some of the largest firms, especially in apartment complexes, which counts as commercial spaces, although it technically is within residential zoning, is technically a commercial product. It's technically commercial space. These companies, these large Wall Street funds, are buying up massive amounts of apartment complexes and jacking up rent, which people have no doubt been experiencing for a long time. This has actually been a trend going back as far back as 2015. And in this table that's in this article, you can see that private equity firms were behind 85% of Freddie Mac's biggest apartment complex deals. These are government-insured loans to purchase these properties. Part of what's discussed in this article is the subject of affordability, which is, although this article is very outdated, does concern huge problems of affordability, especially in low-income housing. This problem became the catalyst for what collapsed the housing market and what led to a massive recession during the Great Financial Crisis, after 3.7 million households were put into foreclosure. There was hardly any rent available, and all of the prices of rent was jacked way up, raising the cost of living for people who were living in metropolitan areas, very densely populated cities. Thankfully, this came at a time when inflation was actually lowering because of the loss of equity throughout the housing market. However, what's different now is we're having the opposite problem. Inflation, while it is dropping, is still at a record high in the United States year over year. We're still experiencing more than 6.5% inflation, which is way, way, way above the target rate of 2% that the Fed sets. The combination of this extremely high inflation with a housing crash still has yet to truly hit the market in a way that has wiped out all the major creditors that are still trying to hang on for dear life. At this point, I feel like most of the financial firms that are the most at risk are hanging on by their fingernails and have yet to actually lose all of their equity and cause the cascading effect, this domino effect of defaults and crashes. What nobody is aware of yet is that starting in March is when all of these major foreclosures for the largest boom towns that were the hottest housing markets during the bubble period are now going to start becoming eligible for foreclosure. Austin, Texas specifically is one of the hottest housing markets, and Boise, Idaho as well. These two housing markets combined are spending more than 60 days on the market on average. All of the new homes that all these investors poured all of their money and their hopes into for Austin and Boise, Idaho, all of their homes have been relisted on the market and they're not finding any buyers, and their prices are dropping dramatically. This is a huge signal of a crash that's been due to arrive for a long time. And this is my message that I want to bring back to everybody to kind of give them a heads up of what's going to come this spring, because these are only the institutional investors whose homes are on the market right now. These are the guys that bought up all of the homes, jacked the prices way up, and hoped that they would sell for a profit. And when they didn't, they went underwater quickly. Now, starting in February, is the opportunity for average single-family home owners to sell their homes and try to get out from under them and try to capture what's left of the hotness of the housing market. But the problem is that it's all coming at the same time, along with heightened inflation. Right now, the data that is currently out on the housing market, which is extremely delayed, by the way, going all the way back to July of 2022, shows that the median price of sale of homes sold in the United States were going for $454,000. That's no longer the case. It's actually been dropping massively ever since that time, and real estate firms that are big data providers for this data are not releasing their information, or at the very least are delaying it in a way so that the public does not become generally aware. I'm trying to tell everybody this because this is coming. This crash is just about here, and it's going to get triggered once all of those homes get thrown out onto the market and the foreclosure wave hits. First, it's going to be the wave of houses starting in February and coming all the way throughout the rest of this summer. And then after that is when all the foreclosures and the evictions start going through. Once that happens, we're going to see a massive drop in equity in the housing market like we've never seen before. And the first thing that that's going to affect is the banking sector. All of these major finance groups, specifically Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, BlackRock, Blackstone, Goldman Sachs, and Citigroup. These are some of the largest names in the financial industry. When all of them see their investments in real estate go under, their stock prices are going to plummet massively, and it's going to cause a domino effect of a wave of defaults in the financial services industry that will cascade into all the other sectors as well. It will force companies to make some very hard decisions about what their future is. My reason for telling everybody this is that I do not want anybody to be fooled by this recent recovery in the market. This is still just a bear market rally. The bear market is not over yet. And I don't want people to get suckered into believing that this is the turnaround point because it's too soon. Things are still not okay in the market. Things are still not okay in government. Things are still not okay in the economy. And right now, as the government is wrestling over the decision for raising the debt ceiling, there's a lot of opportunity for mistakes at the Fed, in the government, and throughout the market. I'll take the time to create a more dedicated and more thorough video for everybody to go through and analyze and cross-reference for themselves. Compare my data to what you have and what you've been analyzing. But whatever you do, please do your own analysis. Make sure that you understand this stuff and do what's right for you and your family. At the very least, have money set aside and be prepared for what's to come, because we're not out of the woods yet. I wish everybody the best of luck and have a hell of a time in the markets.